Do you really have a 3.25% rate on your mortgage or on all your debt? Are you juggling consumer debt, auto loans, or credit cards? If so, you might be missing out on a golden opportunity to save thousands of dollars. That's tax-free dollars. Hi, my name is Karen Jones, and I'm here to introduce you to the secret refinance strategy. Consumer reports share that the average family has depleted their savings and credit card debt is at all-time highs. Families are starting to feel that there is no way out of debt. In this video, we'll explore how this specific refinance strategy can not only help you consolidate your debt to lower your overall monthly payments, I'll show you how you can save thousands of dollars and grow your wealth like the 5%ers do. What is a blended rate? Many families took advantage of the lower interest rates that were being offered a few years ago, and you might just be one of those homeowners. You have a low mortgage interest rate that you're not willing to give up. However, is that lower interest rate really the best way to leverage your money? What is your blended interest rate? The first question you want to ask yourself is, how much do I owe in consumer debt? That's auto loans, installment loans, credit cards, revolving lines of credit. What do you owe and what interest rates are you paying? We're going to show you an example of what a family could be facing and how they can be helped with this refinance strategy. This family has consumer debt, as a lot of families do. And our first step was to analyze what they currently owe and what their actual blended interest rate is. First, we added their auto loan. Next, we added their credit card debt. Did you know that over 2 million consumers owe more than $50,000 in credit card debt? And take a look at your own monthly credit card statement. If you're like most consumers, where you're making either just the monthly payment or a little bit more each month to chunk that debt down, it's going to take some time to pay off that debt. The higher the balance, the longer the time. For example, let's say you have a credit card account that charges an 18% interest rate and you have about $10,000 on that credit card. If the minimum payments are equal to interest plus 1% of the balance, it would take 342 months to pay off that debt by making the minimum payment alone. That's over 20 years to pay off that debt. Now, there might be a better financial strategy here by refinancing and consolidating all of that debt into the new mortgage. Let's say in this example that the home was purchased 4 years ago for $500,000. This family invested $100,000 as their down payment and their mortgage is around $400,000. Now, as we all know, home values continue to increase. And while an appraisal will determine the actual value of the home, let's say that the current value of this home is now $660,000. After making payments and using the normal amortization schedule, as this particular family was just making their required monthly mortgage payment each month, that $400,000 mortgage balance is now around $362,000. Let's say this homeowner refinanced 2 years ago to take advantage of those lower interest rates. They were able to obtain a 3.25% interest rate on that mortgage and have continued in just making their required monthly payment each month. They would have 28 years remaining on that mortgage. Their current principal, interest, taxes, and insurance payment is $2,666. Now, clearly, with interest rates being higher now, it would be crazy to do just a rate term refinance. We advise this family to refinance their home. Let's say we're taking this homeowner from a 3.25% interest rate to current rates. Let's just say it's about 7.75%. The closing costs will be added to the loan balance, so there will be no out-of-pocket expenses to the family whatsoever. This family has debt, which right now a lot of families have. If you have debts like most consumers do, then we can do is eliminate those debts into the new mortgage by increasing the mortgage side instead of just doing a rate term refinance. And this is what we did for this family. Let's see what happens. Currently, in this example, this homeowner is paying $5,710 per month for all of their debts. And what we're going to do is not a rate term refinance. What we're going to offer them is a cash out refinance. With the rate term refinance, you're not able to take out equity to pay off debt. So with the rate term refinance, if they just did that, their monthly mortgage payment would increase by $794, and that would not be helpful at all. When we tap into their equity, what is that going to do to their overall payment? Because the loan size is going higher, right? Well, currently, they're paying $5,710 a month for all of their expenses, their mortgage, their auto and credit card debts. How much would they be paying if we did that cash out refinance, even if the rate was higher? We tapped into their equity and paid all of that consumer debt. That new loan would cost them $4,152 per month for the principal, interest, taxes, and insurance. And that's a huge savings of $1,558 each and every month. And that savings happens every month. Tax-free money. That's like making more income each year, between $30,000 to $35,000. This is huge. This can be life-changing for this family. But what if we did something different with that savings? Instead of pocketing it and spending it on whatever comes their way, we educated this family how they can invest that money back into their home by making principal reduction payments. So essentially, they would still continue making the same payments each month, but just making them smarter. What would happen if they did that? What's going to happen? Let's remember on that existing mortgage, they have 28 years remaining on that loan. The new term will only be 12 years and 8 months due to the principal reduction payments that they've been making each and every month. And what does this mean for this homeowner? This means that they would be saving 15 years and 6 months worth of monthly payments. How many payments is that? That's 186 payments. Does the client need to wait 12 years and 8 months for them to start benefiting? No, they start benefiting right after the first month. So let's show you a side-by-side comparison. If they didn't decide to proceed, they would have their first mortgage with their current balance and their $104,000 of consumer debt. The right side reflects the cash out refinance mortgage with a new loan size of $468,699, but with no consumer debt. Let's see what this consumer's mortgages look like 5 years from now. The remaining balance on the existing mortgage plus the remaining consumer debt, which totals $375,000 plus. If they chose the cash out refinance strategy and reinvested their savings into that new mortgage at that higher interest rate, their loan balance would be $329,671. That's a savings of $45,393. That's guaranteed and tax-free. It doesn't matter what the stock market or the bond market or even cryptocurrency is doing. And this is just the savings after 5 years. What about 10 years? Well, this is where it really gets to start to accelerate. This family would end up saving $192,335 tax-free and guaranteed. But I said that the mortgage would be paid off in 12 years and 8 months. So let's take a look at what would happen 12 years, 8 months from now. We know that there's no balance on the mortgage because it's been paid off in full. They paid off all those debts. It's all been paid off with the cash out refinance. Here you can see that the remaining mortgage, the 3.325% interest rate mortgage, still has a balance of $238,653. So while the consumer decided not to give up that 3.25% mortgage that they loved, well, they're going to have to love it a whole lot longer because they still owe over $239,000. You see that 7.75% that we did by making the same exact monthly payment, just making it smarter, the balance of that loan is gone, paid off. And remember, those revolving balances, they were paid off as well. In this example, the consumer is better off paying the higher rate on the mortgage, consolidating debt, and continue making the same payments, but this time not to a credit card company, but as a principal reduction payment instead. If they did that, they would have a total savings of $294,653. This sounds great, right? But hold on, it even gets better. At this point in time, 12 years and 8 months, you're no longer making payments on your mortgage. However, if you kept that 3.25% loan, you would still be making payments. Just how many more times on that 3.25% mortgage? 186 more times to pay it off. Let's take a look at how much money this higher interest rate mortgage would actually be saving you. You're still going to need to pay your payments on your taxes and your insurance, and I get that. But your principal and interest payment of $1,632 and your revolving payments of $2,000, because it takes about 28 years to get those paid off, which you no longer will have as they were paid off with your refinance, you'd be saving $3,632. Multiply that by 186 months, and how much does that amount to? Well, this homeowner would save over $675,000. And of course, that paid off debt, your grand total benefit after 28 years and 2 months from now would be $731,552. It's life-changing money. You know how many people would be able to have this? You would be in the top 5% of savers in the United States. I am a certified mortgage advisor and went through extensive training to offer you strategies to help maximize your hard-earned dollars. I'm not your typical loan officer just after a loan to earn a commission. I'm dedicated to earning your trust and educating you on options to help you improve your overall financial situation. If you would like to explore your numbers to see if this strategy would work well for you, I invite you to give me a call. Let's explore your options so you can make informed decisions and ensure that all of your assets are working hard for you. Thank you for learning about this secret refinance strategy.